From ImpactAlpha, it's This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week. It's Friday, February 14th. Happy Valentine's Day to those who celebrate. I'm Brian Walsh, and this week I'm joined by ImpactAlpha editor David Bank. We'll discuss how community investment trusts offer a promising anti-gentrification and community wealth building model as local residents take part in the ownership of local businesses. Plus, how this month's list of impact funds actively raising capital puts a spotlight on first-time and emerging fund managers. And finally, how Trump's threat to end the tax breaks for carried interest rattles private equity managers. That's all coming up on This Week in Impact. Hi, David. How are you doing today?
I'm doing pretty well, Brian. How are you?
It's chilly here on the East Coast, but we are getting through it. It's winter after all. How are things in California?
Well, we're bracing for another atmospheric river, a torrential downpour. The problem in California is always too little rain or too much.
All right, well, hopefully you get just the right amount. But let's turn to our first story. First up, our Rudy Sonatas had an interesting piece this week that connects to our larger ownership economy beat. He highlighted a community investment trust, or CIT, which the nonprofit community development financial institution Mercy Corps Northwest has piloted in a lower middle class community in Southeast Portland, Oregon. For as little as $10 a month, local residents have been able to invest in a commercial strip mall, sharing in the upside of the local economic activity. David, tell us how this model works and why it caught our eye as a promising example of community wealth building through community ownership.
Well, for a number of years, I've been trying out a phrase that hasn't gotten much traction. In fact, it's gotten a lot of pushback: inclusive gentrification. And you can imagine why some people might object to it. But the notion is that, property values in many neighborhoods, including in many, low-income neighborhoods or moderate-income neighborhoods, go up, generally speaking. And there should be a way for community residents to ride up with that growing prosperity, not to be displaced by it, as gentrification generally does. So in this particular neighborhood in Portland, most of the residents are renters. They are not, building equity or building wealth in their homes. And so this project is a chance for them to get a little bit of equity in a commercial property. It's on a corner. It's kind of a one-story strip mall. It's got a variety of different kinds of businesses, a taxi cab business, a Somali cultural center, a Latina hair salon, and that sort of thing. And the residents in the nearby neighborhood, nearly 350 families, are buying in, month by month for a relatively little bit. I think an average of like $80 a month, but as little as $10 a month. They get a stake in this property, and through a kind of ingenious mechanism, they have liquidity. They can withdraw their money as well, and there's also kind of downside loss protection. So it's become a bit of a nest egg for some of these families. We talked to a Mohammed Khalid. He's 27 years old. He's an immigrant from Iraq, and he cashed out his stake in the Community Investment Trust to open a bakery with his cousins. Another resident, Sarah Berkmeyer, and she a mother of two, and she put up her shares as collateral to purchase the home finally, where she and her two kids had been living, and they had been renting, and now they're owning. So it turns out to be a way that folks can get a toehold in the real estate market, and also, as I say, benefit from the appreciating values.
So tell me more about this downside protection and how does that work? So how are these investments, if you will, protected?
There's something that I hadn't known about. It's called a direct pay letter of credit. And essentially, it secures the value of the principal and lets the investors withdraw at any time. So there might be ups and downs from when they invested, but they're at least assured they're never going to lose their original investment. And there's the Mercy Corps Northwest, which put together the whole project, had gotten some pro bono legal help from Orrick, the big law firm, and they used a clause under the Securities Act of 1933 and figured out a way to provide this downside. The reason is that you want low income residents to be able to benefit, but you don't want to put them at risk. And if they're saving dutifully each month, you got to have a reason why they shouldn't just be putting it in a FDIC assured, a CD or possibly in the S&P 500 or something, which also obviously can go down. But you don't want to be putting them at extra risk. And so this is a way to give them kind of downside protection.
And yeah, I was struck by the team at Mercy Corps who kind of took a page from behavioral economics and a human-centered approach to how they put this model together, because they surveyed and worked directly with the residents. And what they heard from the residents is that they have very limited dollars to invest and they don't understand it. And they thought that investing is for other people. And that's where it kind of clicked, where it said, okay, well, if you're investing in this commercial property, the strip mall down the block, maybe that's a start. That's something you can see, something physical, and you can get comfortable around that. And for as little as $10 a month, that seems like a really attractive price point for an emerging investor to tap into.
Absolutely. One of the requirements of joining the trust is to go through a 6-week kind of financial literacy course called From Owing to Owning. And one of the advantages is, this is a set of businesses, a mall or a shopping center in the neighborhood. And other folks have gotten keen on this as well, which is, if you own part of that, you might be more likely to eat at that restaurant or get your hair done there or what have you. And so becomes kind of a locus of community, business activity, shopping activity as well as investment.
So help situate this community investment trust into other community ownership models that are, mostly trust-based. So how does this compare to community land trusts or mixed income housing trusts or community investment notes?
Well, there, as you say, there's many different flavors. The basic notion is that some entity, generally speaking, a nonprofit, but it doesn't need to be, takes on the original risk and the original purchase and then sells it back to residents or to whoever the constituency is. And so, conservation kind of land trust, buy the land and sell it to the state park system, for example. This is buy the property and sell it to the residents. And so the trick is in getting that financed up front and what the mechanisms are to sell it and what price it gets sold and then what the governance features are. And that's actually one of the interesting things about the community trust models is how much local governance they have. Because if you are a property owner, you get some experience, good or bad, in keeping up that property and dealing with the new roof or the leaky boiler or what have you. If you're in a more of a collective group situation like this, you have an investment, but you might be more of a passive owner and not get that kind of real estate ownership experience. But you might get sort of a community building experience as you decide what to do or with that property or when to sell it, for example. And there might be a payout at the end. So these things are being used as kind of community building strategies. They're being used as wealth building strategies, as we said. They're also being used as anti-displacement strategies. If, for example, the asset itself is affordable housing, the trust then has some say in keeping it affordable and that kind of thing. So it's probably not it's certainly not a substitute for individual ownership, which lets folks build generational wealth within their own families in a more direct way. But it's kind of got all these other ancillary, maybe co-benefits around community building and as I said, letting the folks who live in the neighborhood benefit from the neighborhood improving and becoming more desirable as opposed to getting displaced when that happens.
All right, so tell me about plans to replicate this community investment trust model in other neighborhoods or other cities.
Well, John Haynes and Mercy Corps Northwest are taking this community investment trust model to a number of cities even this year: Omaha, Nebraska, Albany, New York, Tulsa, Oklahoma, Dallas, Texas, and then they say they've got a dozen more cities lined up. And then, as you said, there's other models in other cities. We've tracked Chicago Trend, which is doing a kind of similar thing with shopping centers in commercial areas in Chicago and in Baltimore. We've written about the Community Vision in California, which is got some money to spend on putting land aside for these kinds of things. There's a number of activities and different projects going on in Boston, one of them being a big affordable housing project, as I mentioned. So there are many players, many different models and structures, and they all bear some inspection to make sure that they're really good for the communities that are investing. But it's definitely becoming kind of a category that folks might want to look at as a way to spread the wealth a bit.
All right. Well, we'll continue to cover this as part of the overall ownership economy beat that we have at ImpactAlpha. And you can read Rudy's article on ImpactAlpha.com. There's also a link in our show notes. But for now, let's take a quick break. And when we come back, we'll put a spotlight on emerging and first-time fund managers featured in this month's list of impact funds actively raising capital.
Maybe it's a story in the brief, or our monthly Agents of Impact calls, or an exchange in one of our subscribers' Slack channels. Impact Alpha is all things impact. Hi, I am Slayma Bibel, co-founder and chief operating officer of Impact Alpha. For more news and insights about the world of impact investing, join thousands of others finding alpha and impact. Visit impactalpha.com/subscribe to learn more.
It's a long-running contradiction of impact investing. Emerging fund managers, including those raising their first, second, and even third funds, generally outperform more experienced general partners. And investors are keen for new strategies that can help them diversify their portfolios and gain exposure to untapped opportunities with potential for impact and, yes, alpha. Yet emerging managers often have the toughest time raising capital, fenced out by perceptions of risk and investment policies that exclude them from even being considered by many asset allocators. So, David, each month we put out a list of funds that are actively raising capital to try to put a spotlight on some of these. And I know this month there is a big focus on emerging managers. So tell us about that.
Yeah, the list, that's with two eyes for impact investing. And it's a monthly feature. And we're very happy that now it's becoming much more of a sort of ongoing feature. So we've revamped the database and now the fund status is updated. And we have additional ways around asset class and geography and investment focus and that sort of thing for folks to search for impact general partners or impact fund managers. And the original notion, as I think folks who've read Impact Alpha will know, is that these are actionable opportunities. These are open funds. We often would report, obviously, when funds close and reach their fundraising targets, but then nobody can get in on it. And so we wanted to make sure that if folks wanted to find these kind of innovative and impactful managers, that they could do it while they still had a chance to act on it. So we've made the database much more functional and easy to use. And the other thing we've done is done a little bit of an analysis of the managers on the list that we've featured over the last year. And the list is, can be at any stage and not just early stage or emerging managers, but it tended by virtue of who came to us and who we found to be emerging managers. And we found that one of the real value propositions of the list is to give some exposure to these earlier fund managers who, as you said, need all the help they can get because of these kind of structural impediments.
Double click a little bit on the structural impediments. How do you see those playing out?
Well, just to your earlier point about the outperformance, the arguments in favor of that are that these are sort of young and hungry managers just starting out. They've perfected or refined their investment thesis. They've developed their pipeline of companies that sort of fit that thesis, and those are the best examples they have because they want to knock it out of the park. And so they're young and hungry and have the motivation to outperform. The other thing is they often have lower fund sizes and lower ticket sizes, and those tend to outperform as well. So put all of that together, and there's some good data and research that shows that these early stage and first time and even second time, third time fund managers outperform the more established and possibly less hungry peers of theirs. But the particularly big institutional LPs and even family offices and others have investment policies that sometimes preclude their getting into these smaller funds. They don't want to put down small check sizes. The sort of general argument is it takes just as much work to make a $10 million investment as a $100 million investment as a $1 billion investment. And so if you're guarding your time, you'd want to do fewer larger deals, and then therefore you're too big for these small funds. The other is you don't want to be too big a part of the funds. Then you're overweighted and they're dependent on you, and you also have too much exposure in that fund. And then the third thing is you want a track record for these general partners. And if these folks are early, you don't really know what they can do yet, even though, as I said, you can, as a whole, they'll do better. This particular one or that one, you might not know enough about to feel comfortable. So now the flip side of all that, of course, is that if those big institutional investors and others are not getting in, that's an opportunity for more flexible and impact investors to get exposure to these early managers and get the impact alpha, as we'd call it.
All right, well, I guess we should also do our standard disclaimer here. The list is based on available information sourced by ImpactAlpha. Information has not been further reviewed by the fund managers nor verified by third parties, is not guaranteed for accuracy or completeness, and should not be relied upon as investment advice or recommendations. Nothing on the list shall constitute an offer to sell or the solicitation of an offer to buy securities. How's that for a disclaimer, David?
I couldn't have said it better, Brian.
All right. Well, you can see the full list of impact funds actively raising capital on impactalpha.com. There's also a link in our show notes. For now, let's take a quick break. When we come back, we'll discuss President Trump's plans to kill the carried interest loophole again.
The ImpactAlpha Podcast Network is proud to amplify smart conversations by and for impact investing professionals.
Welcome to the Market Makers podcast, where you can listen in as we interview leading asset allocators, investors, founders, policymakers, and more, who are all working together to build an inclusive economy.
Join Troy Duffy and Lenore Champagne Byrne for the Market Makers, part of the ImpactAlpha Podcast Network.
Amidst his blitz of executive orders and other actions, in the early weeks of his second term, President Donald Trump has also announced his intention to close the so-called carried interest tax loophole. Now, the carried interest loophole is an eternal gift to private equity and hedge fund managers. It lets them pretend their labor income is really just long-term capital gains, which are taxed at a much lower rate than normal labor income. So eliminating this tax loophole has long been a goal of many Democrats and progressives who have long argued that carried interest should be considered wage income as opposed to investment income. Now, David, it's a very big if as to whether Trump actually stands behind this proposal. Just look at some of the members of his administration who made their fortunes via private equity, who are likely to personally oppose this plan. But tell us a little bit about what the plan is about and walk us through how carried interest works right now.
Well, as you mentioned, it's kind of an irony. First of all, let's just stipulate that it's not the highest on the list of all the things going on in the new administration, but it is an interesting footnote, and it's particularly interesting, as you say, to fund managers, impact or not, because this carried interest exemption it has been so key to the sort of fund structures. When people hear about a 2 and 20 fund structure, that means 2% fee for the assets under management and 20% of the carried interest or the profit on the actual investments that the fund has made goes to the fund manager. So they're living in the short term, in the early years of their fund on the 2%, which is not a lot of money to pay all the expenses they have, and they're really banking on this payoff from their successful investments and getting 20% of the profits.
Why are impact investors, or I should say some impact investors, perhaps divided on this proposal?
Well, I would say that it's split, and it will be very interesting to see how it plays out. And we've talked to a number, on both sides of it. And I guess as a populist plank, it does stick in people's craw that the rich, fund managers or the generally wealthy fund managers are getting a tax break for what it really is sort of almost their commission in a way, or their bonus or something, which in other contexts is taxed as ordinary income. They're investing other people's money for that matter. I suppose it's a kind of sweat equity. They're living on these relatively small fees at the front end, and therefore waiting for their labor to pay out. But again, that's a labor question, not an investment question. So it feels more like ordinary income on the sort of common sense of it, and so therefore the left, so to speak, has always been against that exemption, and then usually Wall Street types, as you said, or other donors have been in favor of keeping it. Now the shoe is a little bit on the other foot, especially if the impact fund managers, are opposed to it. It might be one of the things where it's kind of like, embrace it and hope it goes away and blame it on somebody else. So we'll have to see how that plays out. But it's one of the sort of interesting kind of double reverses in the early days of the Trump administration.
Right. And as Amy Cortese pointed out in her piece on this proposal, that private equity managers have mostly been silent on the proposed changes since Trump unveiled it. And one reason might be his focus is really on extending his 2017 tax cuts, which are set to expire at the end of this year. And the reduced corporate tax rates will help offset some of the losses from this deduction. But they also are probably just betting that this is just a negotiating ploy or a saber rattling, and that ultimately he's going to back down, and the carried interest loophole will live to fight another day.
It always comes up in every budget cycle when they're looking for offsetting revenues to offset the cuts. So the total tax take for these folks might well go down in the new tax bill, and then also, as you say, when all the fine print is done, this one particularly seems to have a weird way of surviving.
All right. Well, you can read Amy Cortese's piece on Trump's threat to end the tax break for private equity and hedge funds and venture capital on ImpactAlpha.com. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thank you, Brian. It's always a pleasure.
Pleasure is mine. And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks as always to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh. We'll see you next week for more Impact.